You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
The pure coal plays are trading at a huge discount to their inherent values. The price to earning tends to be about 1.5 to 2 for these companies, which means that you are getting as much as 50% of the share price in cash in earnings, after tax earning every year.
Hey guys, this is Brian Lenny of Mining Stock Education and Junior Stock Review. Today with me, I have Jayant Bhandari of Anarcho Capital. Jayant, it's a pleasure to have you. I wanted to start off, over the last year and a half, we've seen a number of notable M&A deals across the sector, and even deals that were proposed that didn't kind of follow through. With equity prices so low, especially maybe in the gold sector, there's this difference in valuations. My question for you is, why don't we see a rush for this, especially the senior mining companies, to go out there and buy the best of the best projects that are out there?
Well, thanks for having me on, Brian. Well, it's very simple. A lot of projects which look good on paper are actually not good projects. Or they are overinflated priced projects today. And that is the reason why there has not been a rush to buy these projects. Now, remember, Brian, gold mining companies as a sector have historically been overpriced. They trade for a very high multiple of their NPV. They actually trade a sort of NPV calculated at 0% discount rate using a high gold price. I mean, that's outrageous. And so for them, it makes a lot of sense to create value by buying good projects that are selling cheaply. But that isn't usually the case, and that is why it has not been happening. But having said that, M&A activities are increasingly picking up pace, and this will continue in 2023.
What do you personally think about the deals that we have seen, and even the proposed deals? B2 goes out and takes out Sabina. We have the proposed deal with Glencore and Teck. Do you see any commonalities in the stuff that is happening?
Yes, because again, as I said, the gold mining companies need to acquire other projects. This is what market is asking them to do. The reason why they trade for a higher multiple, they're at a very good valuation, because market expects them to go out hunting for new projects and create value that way. These companies can't really create any more value by mining what they already have in hand, because that value is already priced into their share price. So they have to really go out, and that is the reason why Sabina got bought out by B2 Gold. Now, the case with Glencore and Teck is slightly different, Brian. The funny thing is that the pure coal plays are trading at a huge discount to their inherent values. You look for, Peabody Energy or Coronado, West Haven, coal companies, and the valuations are amazing. The price to earning tends to be about 1.5 to 2 for these companies, which means that you are getting as much as 50% of the share price in cash in earnings, after tax earning every year. And these companies are sitting on billions of dollars of cash. And the reason they are sitting on billions of dollars in cash is because they know that when the time comes, fund managers and banks won't give money to these coal mining companies. So these coal mining companies are trading at a huge discount. So if you think through the thinking of Glencore and Teck Cominco, you will understand that they need to get a spin off the coal projects, so that the remaining portfolio starts getting valued the right way. Now, Glencore clearly thinks that by doing a merger, they can acquire Teck cheaply. Now, I am, I follow Teck, but I'm not an analyst for Teck, so I don't know the valuations as such. But these companies are all trading for, even base metal companies are trading for P/E of 4 to 7. So that is where Glencore probably sees a value, which is to merge the two companies and then spin off the collective coal projects into a separate entity. Now, of course, Brian, as you and I know, spinning off coal projects into a new entity isn't going to solve the problem of carbon dioxide emissions, but this is how the thinking among the fund managers is today, that they want to not invest in coal mining companies, and that is why a lot of companies that have coal projects in their portfolio are undervalued in the public market.
Okay. And so, you look at M&A deals and, the stuff you brought up, has to do with the business expansion and being valued at a higher valuation due to, adding ounces in the ground to your balance sheet. There's a number of other factors that I think could play in. You got, jurisdiction, economics of the specific project, maybe the size. Size was in my view anyways, was a big deal last cycle. We saw them at the top of the market, in fact. They were going for huge ounces in the ground. Economics was kind of thrown out the window, and they just wanted to add to their coffers. So out of all these different factors that are driving or they're out there, do you think there's any specific one, given the environment that we're in today, that the companies will look at and say, hey, you know what? We've got to go for the best economic project, or we've got to diversify?
So, Brian, it's very interesting. I was at a conference last week, and one person mentioned that these days it takes 23 years on average for between finding a project to putting that into production, which means that if I'm expecting a 20% return on my capital, I should get every dollar that I invest today should give me about $50 or more 23 years later to give me a proper return on my investment. So it is absolutely outrageous the time that it now takes to put into production. And the problem with big mining companies is that the only way they can create any perception of value creation is by acquiring big projects. Now, big projects take a very, very long time to get permitted, and they take a long time to get go into production because they have to do all the environmental work, they have to do the permitting work. And remember, all these projects that look all cute and fully ready to go into production might still take another 5 to 7 years before they actually go into production. I know projects that were about to go into production when I started working in the industry 17 years back, and they're still sitting on the shelf and is still ready to go into production. So that's the issue with the market. Now, ideally, if given a choice, I actually, unlike a lot of other people, prefer small projects, because small projects are usually not followed by the market. They tend to trade at a cheap valuation. The permitting is usually easier. And because you are going to be investing a lower amount of capex, so you might be in a position to use capital equipment in the nearby areas, you can actually manage risks very well. Of course, the problem is that such projects should actually be private companies, not public entities, because public entities entail corporate expenses of about, let's say, $5 to $10 million a year. So, and that actually destroys the economics of a small project. So, we are really because of the permitting environment, we are really between a rock and a hard place today, because big projects take forever to go into production, which means that they really don't have, on a discounted cash flow basis, much value for me today. And it is only big companies that they think they can put those projects into production would be interested. But also remember, big companies are interested in projects whose permitting risks have been lowered significantly by the current management, because permitting risks actually increase once the projects go into the hands of the major, because the bureaucrats then want more work done. The natives want more money for those projects. So this is a very difficult process. and the market does not give you enough returns for what entails in bringing these projects into production.
So if I'm understanding you correctly, the more de-risked a project is, the more attractive it is to a major mining company. Therefore, would it be on the production side? So we're almost looking at, the merging of equals or something that's already in production. Those would be at the top of your list in terms of companies that are most likely to be taken over. Is that correct?
Well, yes and no, because also once you are in production and once you are actually churning out money, two things happen. The managements that control that entity does not want to get acquired because they are earning good salary at this point of time. The second thing is that risks are significantly lower by this time, which means that the market valuations tend to pick up quite a bit. So these two things happen. I saw a merger last year, Brian, and it was very roughly a merger of a total merged entity was maybe about $400 billion. But the management of the company that got acquired got paid, believe me or not, $26 million in severance. Now that's absolutely crazy. But this is where the high expectations of the management come into being, and that is why Brian, we have talked about this many times in the past. We really like managements that have a skin in the game, managements that are honest, ethical, and business savvy.
Absolutely. Whether it's sanctions, war, recessions, cost of energy, all these have an effect on the supply chain. And I think one of the big topics that's out there right now is security of supply. So in your view, does security of supply of critical minerals moving forward, does it become a bigger issue moving forward?
I don't think so, Brian. I have been in the industry for 17 years. And what I have 17 years back, people were talking about peak oil, peak uranium. Uranium went up to $150 a pound. Oil was 120 of those days, in nominal terms, which is more than $150 today. So, all these, there was a huge euphoria about graphene and REEs. At different points of time, copper traded at about $4 17 years back, which in nominal terms mean about $6 today. And the expectation those days was, and everyone was showing exactly the same slides to us, which was that there would be falling supplies and increasing demand, and there would be a massive deficit within the next few years. And that was 17 years back. And they still show exactly the same slides to me today, with the dates changed. The reality, Brian, is that people who are consumers of these commodities have a lot of options to protect their future supplies. For example, you can do future contracts of base metals on LME or other exchanges. Or if you have demand for lithium or commodities that are difficult to trade openly in the market, you would invest in relevant projects to do with those commodities. So, for a car manufacturer, the amount of copper that goes into his car or amount of lithium that goes into his car is relatively insignificant, although it's a huge amount of commodity overall that goes in. But so he's not going to take the risk of having his car not being able to go on the road just because he lacks access to lithium or copper. So, these are very liquid commodities. They trade well, and he ensures that he has a supply coming online in the future. I was in a conference in Shanghai a few years back, and there were a lot of companies who were investing in lithium companies to protect the future requirements of lithium for themselves. So again, I'm not necessarily too euphoric about prices as such. I think there is a huge amount of elasticity in terms of demand and supply. If the demand goes up, the supply, the marginal ore that is with mines comes into play. Marginal mines start coming into play. So there is a dampening effect on rapid increase in prices of any commodities. And if a commodity price increases rapidly, then actually the end product becomes expensive, and then demand for those products fall. So, market has its market is very complicated. It's a long chain of supply and demand, and the market takes care of all those things. Now, Brian, just to conclude this thing, this does not mean that there's a huge amount of volatility in the market. Copper goes up, many commodities go up from by 50% and fall back by 50%. This happens all the time. But sitting here today, I can't predict looking into tomorrow what would happen. And just the last thing, Brian, a lot of commodity traders, if you talk with them, they actually don't want to sit on any of their commodity investments overnight. They hedge their commodity trade right away. So if they buy from some place, they sell the futures of that commodity elsewhere right away to hedge themselves against any commodity price risk. So one has to be very careful about being too euphoric about the future of any of the commodity prices.
So Zoltan Pozsar wrote, investors are not particularly well trained to deal with geopolitical risk because for generations, geopolitics didn't matter. Anyone who traded securities or ran a portfolio since the end of World War II did so in a cocoon of a unipolar world order.
Oh, absolutely. Absolutely, Brian. This is mind-boggling. People simply don't understand other jurisdictions, and I have seen this again and again. And also the media and politicians lie to you non-stop on both the sides. So the end result is that people don't really understand what's happening in other jurisdictions. And when they go traveling to other jurisdictions, they go for the beaches and they have fun in other jurisdictions, or they experience other jurisdictions with through tainted glasses. So people's perception of other cultures and other jurisdictions is very flawed and very skewed. And that leads to a massive amount of malinvestment. Now, for example, look at Argentina. Argentina consistently fails to repay its foreign loans. And foreigners consistently, and these are big fund managers giving billions of dollars to Argentina, they keep giving money to Argentina and then they lose money again. So even at the level of fund managers who are playing with tens of billions of dollars, they make massively erroneous conclusions about other jurisdictions. And they like to think that everything is going to just continue to improve step by step. And companies want people to think that way because they want to attract money. Politicians want to think that way because it helps them with their politicking. So, the media likes it. So this is just the educational institution, the media, the politicians, the fund managers don't really understand it. And if they understand it, they don't pass it on to you properly. So yes, there's a massive amount of misunderstanding about jurisdictions.
As in terms of investors, would you suggest not even attempting then to try to understand, let's say, another jurisdiction or culture? Is that the most risk-effective way to go about it? Or if you do want to attempt to understand and make a conclusion on it, what is the best way to know if you have a good handle on a jurisdiction or a culture?
Brian, this is what I consistently do. When I go to a site visit, I take my suit off and I put on dirty clothes and I walk the streets. I go to coffee shops. I go to buy bottled water from grocery stores. I eat out where the normal guy there eats out at. That is where you start to understand the local culture. If you always fly business class into where you are going to and stay in 5-star hotels, Zurich is going to look no different from Johannesburg to you. You won't really understand the cultural differences between the two places. Now, as an investor, if you are really trying to invest in a balanced way, you have no other way out, particularly for people investing in commodities, to go out and understand how other jurisdictions operate. So, absolutely, Brian, if you don't understand a jurisdiction, avoid it. Just because you can buy a share with a project in Congo online on TSX, and now you are a part owner of that project in Congo, just because that ownership of shares looks liquid for now, does not mean your investment is safe, because you really, at the end of the day, have to understand what's happening in Congo. And if you don't, avoid investing in it, because you will get fooled. Look at it this way, Brian. In the last 17 years of my career in the mining industry, the venture exchange has fallen in real terms, in nominal terms by about 80%, in real terms by about 85%. So $100 that you invested 17 years back is now worth only $15, when it should have been worth about $500 or more if I accounted for the kind of returns I expect from my investment. So what I currently have as a venture exchange is only about 10%, a fraction, 2 or 3% of what I expected it to be by this point of time. So most people lose money because they ignore jurisdictional risks, they ignore the risks to do with permitting, to do with geology, they overtrust the management, and most importantly, Brian, they get swayed by greed. Let not greed be on the driving seat. Do a proper analysis, understand these projects, given time that you would to when you go to buy any other property. If you want to buy a $100,000 house, you will spend time understanding it. So if you're trying to invest $100,000 in a project, you're actually owning a fractional part of that company and a project. So you should put in your time and effort to understand that.
Absolutely. Over the last probably 2 months, regional bank failures in the U.S. has become a huge topic. At the moment, in your view, do you see U.S. bank failures, do they represent the biggest risk to investors right now?
So, Brian, I started investing in Chinese banks about 4 or 5 years, 6 years back, and I have done extremely well. In these months, Chinese banks have grown in value very nicely, and over these 5-6 years, these Chinese banks have given me dividend yield of about 10% a year. So, Kyle Bass kind of people have been complaining about China for at least a decade or 2 decades. The reality is China has grown very nicely all these days, and their banks have provided me better returns than Western banks have. Well, who knows, Brian, what is to come in the future? People who understand how at the end of the day, you are just flipping paper from here to there. And you can't really take cash out of the banking system anyway, because if you want to take more than $10,000 out of the banking system, they won't give it to you. You might have $10 million in the bank account. So the best you can do is to move it to another bank. So it's all about public perception, which bank people think will stay stable, and that's where they will move their money to. And this is a vicious cycle, and this is exactly what happened to some of these banks. People just thought that because of social media and grapevine rumors, people started removing their money, and every single bank, because this is the way the fiat currency based banking system works today, is that if there is a run on bank, there is a vicious cycle sets in and they will collapse. But because you can't take cash out, some of the major banks will survive, but very likely the smaller banks will suffer unless they have a strong support of local people. So if Warren Buffett likes his regional bank and supports that bank with cash and does not take cash out of the bank, it will still do extremely well. But again, it's very unpredictable because that's the kind of fiat system we have today.
Yeah, in your view, when we talk about risk, and we'll talk about the U.S. bank failures as a known risk, like I said, like the media has been really good about covering it. They love to propagate fear. And is it too simplistic to say because the risk is known that it's less risky?
I think yes and no, because a lot of people don't really understand the risk. They think that Biden and Kamala Harris will take care of all the problems. They think that they have these banks, the depositors have already been covered in all these three banks that have failed. So eventually they will be covered. So they shouldn't really bother. So there's a moral hazard in this because the governments have encouraged that moral hazard. And also remember, just because Americans are more open-minded about letting their banks fail does not mean that their banks are more vulnerable than the banks elsewhere. My guess is that banks elsewhere are more vulnerable than American banks. Americans let the pressure valve work once in a while. Most other countries never let that happen. So, the banking system is in a crisis all over the world, or at least in most parts of the world. And I think the people really have a problem with the fiat currency. It has no backing, and that is where my interest in gold, precious metals, and investments come from, because I hate owning that fiat currency. It loses its value by now 5 to 6% every year. Plus, it can be frozen by banks, and all kinds of things can happen. And I want to buy real stuff with that money.
One of the other prevailing themes it was already coming, but I think with these bank failures, it's again gone to another level. And mixed in with what's happening with the BRIC nations and the move to maybe the petro yuan, people are calling for the end of the USD. And so my question for you is the USD's fall from grace imminent, or is it just inevitable?
Well, so Brian, we can complain all we want about the US. It is still the best country on the planet. It's the freest country on the planet. I love America. It's a great place to be in. It has wonderful liberty-minded people. The US dollar is the reserve currency and will continue to be the reserve currency because the people who back that currency are special people. It's a special country. Recently, Russia and India had been negotiating a trade of $2 billion worth of arms. And because India wanted to pay in rupees and the Russian could not accept it because they don't trust each other. They still, despite that India might not like the US and despite that Russia does not like the US, they still need the mediation of the US dollar to do a trade because they don't trust each other as currencies. So US dollar will continue to be the reserve currency. But that said, US dollar is past its peak and the reserve status is losing its respect as time goes by. So, a lot of valuations happen at the margin. Now, let's say every year the world was taking more and more of US treasuries, and now if they stop taking more and more of US treasuries, then or if they very slowly start selling those US treasuries start to return back to the US. So even though US dollar will stay the reserve currency into the foreseeable future, US dollar's value will come under pressure because US dollar cash is returning back to the US and US dollar bonds and treasuries are returning back to the US, which means that the US Fed has to suck out this excess cash coming from the rest of the world, and or there will be inflation. So they have exploited the US dollar's reserve currency status as much as they could. Those days are gone for sure.
With all the risks that we've talked about today and that are present in the world today, do any of these risks morph how you participate in the market?
Oh, well, you have to be aware of what is happening in the market. You have to try to foresee what is coming next. For example, Brian, I have become increasingly optimistic about the Middle East. UAE is opening up drastically. I was at a conference where United Arab Emirates sent their team to promote UAE as a mining jurisdiction. Saudi Arabia has been doing a lot of job. They are actually getting a lot of money. You always have to keep your minds open about which jurisdictions are opening up and which jurisdictions are losing their status. For example, a lot of Latin American countries are losing their status as prime places to invest money in for mining. Africa probably is still at the same place, which means that overall it has become a better jurisdiction compared to what is happening elsewhere. So you really have to understand what is happening in the world constantly, how currency prices are changing, what new laws are coming, what is happening in Ecuador, what is happening in Colombia, and deal with your investments accordingly.
Does the current environment force you to keep more cash in your portfolio, or does that remain kind of constant no matter what's going on?
But you have to hold cash when you have to hold cash. If I don't see an opportunity, I don't want to force myself into buying something. But at the same time, holding cash is for sure a very risky thing to do. You are losing about 6% a year in inflation by holding cash. And what if your bank account gets frozen? And these things will come at some point of time, Brian. And that is why I think people should actually internationalize as well, so that no jurisdiction can freeze their account completely. You always have to keep hunting for value. And when the world demands more cash in its pocket, you can be reasonably sure that investment vehicles might be becoming cheaper. And that is what I think currently is the case. As I said, coal mining companies are extraordinarily cheap. You can almost blindly invest in coal mining companies and stand to make a profit in them. And I'm talking about not $100 million companies. I'm talking about companies with billions of dollars in market capitalization. So when the market is risk averse, there is a lot of value available in the market. So my cash gets used up quite rapidly in a scenario like that. And hence, Brian, I don't have much cash right now.
The gold price is around $2,000 an ounce, an excellent price. The equities, on the other hand, have really lagged. Why do you think this is?
Well, really look at the profit and loss accounts of gold mining companies. Gold prices might have gone up by 10-15%, but the cost of making that gold has gone up by a similar amount of time. Now, I don't monitor all these gold mining companies very closely, but that is my anecdotal experience from having seen some of the financial accounts. So here is the problem. People who think there's leverage in buying gold mining companies are fooling themselves, because they also should remember that when gold price goes up, the cost of making gold goes up as well. And sometimes, and usually what I've seen is that the cost of making gold goes up faster than the price increase in gold. So you have to be very careful. Gold price has done very well, and I think gold has a fabulous future. This is the only commodity that I like to speculate in. And the reason is that the market hasn't really absorbed fully the chaos and risk that exists in the market today. The system is in a complete chaos. The banking system can come to a grinding halt, can freeze up because of many things. I mean, on the 1st of June, America might not have enough cash to meet its debt requirements. So, so many things can happen. So many the black swans are there. We don't know which one will hit us. So gold has a very good future, but I invest in gold junior mining companies for what I think other might not have seen, and hence I think that those companies are undervalued based on what they actually have. But apart from that, I don't invest in gold junior companies or gold mining companies in expectation of gold price going up in the future.
I read a great quote from Travis Walton. He's the author of Fire in the Sky, and it's regarding human behavior. And he says, I've come to realize that the biggest problem anywhere in the world is that people's perceptions of reality are compulsively filtered through the screening mesh of what they want and do not want to be true. Do you agree in terms of how it relates to the investing world?
Well, yeah, I mean, and now things have become worse because we live in our echo chambers. We have created echo chambers on social media and elsewhere. We talk with people of our kind around the world. So we don't really necessarily go to a pub and talk to a stranger as often. So we get, all the software, the social media software, give us material that we like to read and follow rather than things that challenge us. So yes, we are conditioned into continuing to believe in what we believe in, and most people dug in their feet when they are provided information that challenges them. So even if they know that what they know is not the truth, they still want to dig in their heels because they don't want to challenge their thinking. And unfortunately, that's what the world is like. That also creates a lot of opportunities for the people who have flexible thinking, who are prepared to change their thinking based on changing information. As an investor, I have to stay consistently humble because you make a lot of mistakes, and you have to learn to accept those mistakes and change your decisions at a moment's notice before other people start noticing that information. So, humility is extremely important, and it's not worth sticking to something just because we have invested our ego in that belief.
Going back to the equities and their lagging in valuation, there's a big difference between the valuations and the developers and exploration companies, and it always kind of surprises me that people will pay more or equal amounts for what I call hope versus reality. You see a lot of developers with the same market caps as an exploration company, but the developer has, let's say, 2 million ounces in the ground, and the exploration company is looking for 2 million ounces in the ground, and they'll be the same market cap. So in your view, is this opportunity? And if so, what factors do junior developers have to escape their discount?
God, I mean, it's so difficult to know, Brian, because, every jurisdiction is different. All the different ounces are different. We don't know which ounces have better value. We don't know about the permitting situation, and there are so many factors which give so much noise in that underpinning what you just said. So it's you can have exploration companies trading at a higher valuation than development stage companies, but at the same time, the market would have realized that the development stage company that is all spruced up to go into production might have some fatal flaw in it by this time. So, and maybe not everyone know about it. Only a minority people might know about it who would be selling their stocks or short selling those stocks. So there's so many things, and and there are fatal flaws with many projects that look all ready to go into production. I know of a project, I think it's a 2 or 3 million ounce project in Canada, which looks very high grade. But it's been sitting on shelf for the last 15, 20 years at least, and never to go into production, but always claimed to be ready to go into production. So, the market recognizes those things eventually. And so, I think if development stage companies are trading at a huge discount, you really have to dig in to find out whether there's a fatal flaw with it. And if there's no fatal flaw that you can find, then just buy more.
Right. Well, is there a time limit? Like, I know the cost of capital has been ultra low for the last 10 years. And so the time value of money is definitely diminished, yet there is still that time value of money. But when do you, let's say you can't find that fatal flaw, or you don't think there is one, but it's taking forever for the market to recognize that value. When do you personally think, hey, you know what, I've held this company for too long, it's time to move on?
Well, Brian, this has been one of my weakest spots. So, I have held companies which I think have a 400% upside, and I still own that company for the last 15 years, despite that I think, it has gone nowhere. The problem is that when I clearly see an upside, and because of management stupidities, the upside gets dissipated, gets frittered away. I'm always hoping that some sense will come into them, or someone better will come into their positions to change the future of those companies. So I personally own a fair bit of what I would call value traps. And I really don't fully understand how to deal with those value traps, because there's value, and then I don't want to sell it today, hoping and then it might go up to meet my expectations after I have sold it. So I have done a horrible job with value traps.
It's tough. In terms of investments in the junior resource sector, can you give us a couple companies that are catching your eye right now and you're deploying money into?
Well, one company is Montage Gold. It's trading at 69 cents. They just finished a raise at 70 cents. I think it's an extremely good company. They have found new high-grade ore, and that high grade should significantly improve the economics and internal rate of return of their company. So, and it's a large project as well. So I'm very happy with Montage Gold. Its price hasn't gone up, but prices of most companies haven't gone up. So I'm patiently sitting on it. Also remember that there are actually lower permitting risks in most African countries compared to permitting risks in Latin American countries or the Western world. So if you can manage, if the management is good, it makes sense to pay attention to African companies. I am very fond of a company with projects in Japan. It's called Irving Resources. It's trading at 91 cents today. I actually just bought today the shares at 93 cents. Aztec Minerals at 31 cents has hit some good grades. They are small intercepts, so it's still very speculative. But if they hit more of similar grades where they have currently hit, there's a good upside, I think. So these are three companies that I can think of. O3 Mining is an interesting company, Brian. I might be one of the largest retail non-institutional shareholder of this company, and this company has gone nowhere. And I'm not sure if this is a value trap or is there a good upside in it. I'm still sitting on it. I like the management mostly. I like the projects, and I can't find a fatal flaw. So I'm sitting on it, but that's another company that I think should have value.
Capitalism Morality has made a huge impact on my life, and I think it's well worth people's time to explore and hopefully one day attend. Capitalism Morality is expanding. You're doing a second conference this year in Calgary. That's going to be on May 20th. Can you give us some color on who will be speaking there and where people can find out more information about the conference?
So the next conference is on the 20th of May in Calgary, and then the Vancouver conference returns on I think it's on the 9th of September 2023 in Vancouver downtown. Amy Wax will be speaking. She is the keynote speaker. She has recently been, I think, fired from her position at the University of Pennsylvania. A fabulous lady, and I think she's someone worth listening to. Maxime Bernier of People's Party of Canada is a speaker, and I think he's a great hope for Canada. if Canadians wake up, he should be the Prime Minister of Canada. He's speaking as a keynote speaker. Adrian Day will be there. Rick Rule will be there. Jeff Deist will be there. Jason Nutter from Singapore will be speaking about Singapore, and the Consular General of Singapore in Canada, Terry Salmon, will be there speaking as well to talk about what Singapore has to offer. We create a forum where we discuss philosophical issues, and no question goes unanswered. So speakers get challenged by the audience, and these people will hear good and bad things about anything that they talk about, including Singapore.
Excellent. Jayant, it's been a pleasure, and I hope to talk to you again soon.
Thank you very much for the opportunity, Brian.